taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome back to Total Money Management. I'm sat here with Steve Moriarty and Jacob Senior. How are we going, gentlemen?
Excellent. I'm all good after the tennis. I'm actually really tired. Midnight nights. It just never stops.
Talk about a name dropper. Me at the tennis at the Australian Open. Did you see myself?
Did you see me on TV?
Here I am drinking a cocktail while watching Novak Djokovic.
In the most comfortable seats in the stadium right next to the bar.
Yeah.
All right.
You young people are so unbearable. Here's me on my private jet. Oh. Got that photo out, mate? Got that one on Facebook?
Yeah, go to Jacob's Facebook. You'll see that one.
Is this just a rinse Jacob
Ascoli, is it? Mr. Jacon. Sorry, private joke, folks, but Jacob's been at the tennis.
It's been nice.
Whereas Tom and I have just been slaving away in Brisbane.
We're just common men.
Just common men.
Oh, God.
Dear. Anyway, gents, what do we got? What's happened in the world? Anything of absolutely riveting interest?
Yeah, well, I think we did the last one a week or two ago. And again, we're going to be kind of recapping recent events for the last fortnight and kind of discussing anything that might be relevant. Obviously, January, this is when we're all planning, how we're going to allocate our money for the year. So, yeah.
I've got a good one to kick off. I think a couple of weeks ago, in the week that was newsletter for the subscribers, there was basically an article saying top performing ETF in 2023 returned over 214%. And it's incredible. However, it's so shrouded and covered in recency bias, I can't even breathe.
What is it? What's the ETF?
I think it's a crypto one, to be honest, just reading through the article. And I'll talk a bit more about that later.
Next.
But no, I just wanted to give the viewers an example of how much recency bias is in the media. So this is an article that's saying top ETFs of 2023 offered returns upwards of 40% for the year, with the highest offering a cool 214.5%. And in small caps down the bottom, it's saying, noting that even with extraordinary performances, some of the top 10 have failed to recoup losses since their inception. So
there you go, eh?
Amazing in 2023, but if you invested in 2018, you'd be buggered.
Yeah, drop 99% in 2019, but
another 400%, and I'm back square.
Your $100 went to $1, but now it's at $3. So
but that's so true. That's what happens, right? Because everybody pinpoints and says, last year I made 200%. It's like, man, you are a genius. I'd lost 5,000% before that, but I made 200%.
Did you invest last year, or did you invest 5 years ago?
Yeah. But that's the thing about time. That's the really important point about time, isn't it? Because everybody, you think about it, there's no difference between December the 30th or the 31st or the 1st or the 2nd of January. They're just different days.
Yeah.
Right? But everybody's now talking about, these are the stocks that are going to do really well for 2024. Okay. How did your stocks go for 2023 or 2022 or 2021? Did they do really well? But the other thing is, so in other words, I shouldn't, being stupid, but so why didn't you tell me in November when I could have, got it at a lower price? Because now everyone's going to pile into it or something.
November's not as bullish as Jan 2. All right.
Well, yeah, but but it was last year. But you're right. Everybody's out there flogging predictions about stocks and ETFs, and this is going to do great. That's going to do great. But if you look at their predictions last year, everybody said, sell the US, buy China. So what happens after 12 months? US goes gangbusters, and the China stock market drops like 25%.
Yeah,
they're completely the opposite.
Well, I think China's at the bottom of last year's returns.
Yeah. It's like minus 20 odd percent or something.
Minus 25% at the bottom there with.
And now nobody wants to talk about. Everybody wants to talk about China and how bad the property market is, and all of that stuff, which is absolutely valid. But if you're an investor and you want to make more money, you don't go and buy Nvidia when it's PE 8 million.
Yeah,
you're better off buying China. Where what's the cape on China? Like
9.6. The 10-year returns is like negative 23 or 24% or something.
Yeah. But see, that's the point of this stuff, pardon the pun, where we do it in well too.
Yeah.
Right? They look at those since inception dates, but the real point for any investor is, well, where did you buy it? Did you buy it when it was minus 25%, or did you buy it the year after it made 25%? And as we know, you're better off looking where the awful stuff is rather than where all the, last year's ETF made 214%. Well, I'm in.
Yeah.
And it's like, dude, it's made 214% already. It's unlikely to go much higher.
Yeah, yeah.
I mean, you look at another example of that, right? And again, I'm jumping around, but I was looking at the emerging markets chart this morning. And in 2021, obviously Turkey dropped 28%. And I remember you talking about buying Turkey.
Yeah, I love Turkey.
Then it does 90% the next year.
Yep, I love Turkey. That's the reason why. Every time you look at
So
Turkey,
volatile.
it is. But but this is what I'm saying. Look at the thing every time they're negative,
Yeah.
right? Look at emerging markets. Get the quilted returns up. Look at all the ones that are negative, right? Now, look at them the next year or the next 2 years or the next 3 years. Are they still negative if you bought them after they'd fallen?
Sometimes, very rarely.
Very rarely have you lost money by buying them when they're down the bottom or even when they're just negative, right? And as we sort of explain to people, it's because of the rebalancing, right? If you're an emerging markets fund manager and you've got, say, $1 billion, right, you've got to put that money to use. At the end of December, you've got to rebalance the portfolio. So how do you do that? You take from the winners and you put to the losers, right? So you take from Mr. 214% and you put it into Mr. minus 25%. Now Mr. 25% starts moving up, and what happens? The narrative kicks in. Oh, actually, China's not as bad, and it's, their stimulus and export market.
Yeah.
Actually, China's looking pretty good value. We all pile into China, and it makes money again.
Yeah. Well, for those playing at home, the Novel Investor, great place to go if you want to check out those past performances.
Yeah. It's a really good site.
That's a good plug. I wonder if they're paying us any referral fees on that.
Any enormous things.
I'll take a coffee.
For the three listeners that actually know that. Righto, what else have we got?
Oh, I think we want to talk a little bit about mean reversion, but we discussed it a little bit then, looking at the bottom three.
Yeah. It's just the mean reversion is often referred to as the first law of investing, and it's really obvious. But the question most people say is, yeah, but when? And my argument is, it's not about when, nor is it about why, because so many people want to know why something's going to happen, right? And later this month, depending on when this gets out, or may have been last month, we talked about black swan events in a masterclass, right? And it's really, really important, because what people say is, oh yeah, things are really ugly. Why is it going to get better or get worse? What's the black swan event that crashes the economy? And it's the very definition of black swan is you don't know what it is.
And it doesn't actually matter as long as you prepare, is what we're trying to say.
Yeah, the CAPE ratio in the US is what, 32?
Yeah,
right?
hair over or something.
Yeah. Well, I don't care if I don't know the event. All I'm telling you is, at 32, you're really asking for punishment, right, if you got a lot of money in the US. Now, it's also had a run-up from the Cape of 13 in 2009. So you've made like 450%.
Yeah, and
right? You just look at that and say, do you think that'll continue? And it's like...
Well, there's been a black swan event almost every time the Cape's been at this level.
Absolutely.
We've spoken about it, and we'll continue to speak about it probably every 2 weeks, but it's so important for people to realise that.
Yeah. I don't know. Look, if I said to you, oh, Jacob, it's February the 15th and it's going to be, it'll be a volcano in Turkey, right? That'll cause global market disruption. You'd say to me, you're a dickhead, that's wrong. How do you know that, right? Well, I don't. But that's not the point. The point is, at 32, you're really asking for it, even on a fundamental basis, by saying, okay, the returns are going to be like 2 or 3% for the next 10 years.
Yeah, look at the returns, look at your asset allocation and the risk, and then take a breath and go, okay, is the likelihood of this continuing to go up high or low?
Yes.
And then look yourself in the mirror and take some money off the table.
Look, this is where it gets confusing, right? Because
No.
well, a little bit.
Yes, yes.
Because there's so
Yes.
much conflicting information.
Yeah,
right?
yeah, absolutely.
We know that the Cape is an extremely strong indicator of, whether a market's expensive or not.
Over 10 years.
Yes.
Yep.
And, historically, that's been a good indicator. What it won't tell us is exactly when it's going to pop. So we know that the Cape can stay high for an extended period of time. If we look at 2024, we go, okay, we've already had the Cape high 30s for the better part of the last few years. In saying that, there's also a lot of bullish factors where you're going, look, there's a big election in the US this year.
Yep.
Historically, like looking at some data, I think you posted, Steve, 14 out of the last 16 election years have been a good year or a strong year that's had positive returns.
Absolutely.
And the two losing years had a high Cape.
Exactly. That's exactly the point, though, because what people do is say 14, and I do this the same with December, right? If you look at December, it's generally 85% of the time, it's a really good month. But you've got to then say, oh, that's good. I wonder when it's not a good month, right? And it's the same with presidential elections, right? You do the same thing. You can have a blanket probability of, look, it works 85% of the time. Okay. When doesn't it work? Oh, it doesn't work when what? When the Cape is really high. Now, there will be times when the Cape is high and it will work, but this is what we keep coming back to about this argument of Cape is not all or nothing. Like, all we're saying is, look, if the Cape is really high, you probably don't want to have a lot of money in that market.
Yeah.
Or have a shortest term strategy.
Yeah.
Right? Like,
Or there's a better place to fish, right? You go fish somewhere else.
Yeah. I mean, like we just said, China's what? 10.
Yeah.
Cape of 10. Okay. America's a Cape of 33. Pick which one you think will do well over the next 10 years. Now, go and look at America. America's done 400% over the last 10 years. Well, the decade before that, it did terrible, right? From a high Cape of 44. So what I'm saying is when you look at those simple charts and you start to drill down a little bit, and to your thing about the presidential elections, oh, well, when didn't it do well? Oh, when the Cape was high, like it is at the moment. Right?
but how many presidential elections was the Cape high and we still had a good year? I didn't actually go look at that.
No, I know, but that's what I'm saying. What I'm saying is you when you focus on not losing money, what you want to do is look at those cases, right? Because you don't learn that much from making money, right? Because it's the same. Everybody does the same thing, right? And we've got some stuff in there about property which we can talk about, but it's the same thing, right? Everybody's making money in property because we're in a property bull market. Now, I shouldn't say everybody because I know some people who aren't, but my point being, if you look at the historicals of property, it all really went gangbusters in 2000. I know because I bought property in 2000, right? And so what I'm saying is when you look at a lot of people talking to you about how to make money in property, they're all gone in about the same time, right? Between 45 and 55 years of age, they all were earning a good income and they all got in and around 2000. And that's what I'm saying. That's the really important part of understanding the histories and drilling down a bit to say, well, when did the Cape work when the president was elected and the Cape was really high? That's the one you want to point at. Because if you lose 30%, that's the real problem because then you've got to make a hell of a lot more to get back. Mm-hmm. Now, it doesn't, people make this mistake of Cape of going, oh, well, you'd have lost money because you've missed out on all these returns. Well, that's bullshit for a start because you'd be an idiot if you said, oh, I'll buy the Cape at 15 because it's below average, but I'll sell at 18 when it's above. I mean, that's just crap that people put out, right, to diss the Cape ratio. It's about gradations of allocation. Right, that's really what it's about. High Cape, okay, if you want to be in the US market, you've got two choices, right? You can use a short-term strategy and use technical analysis, which we'll talk about, or you can say, well, I'm just not going to be in China, I'm not going to be in the US, I'm going to be in Turkey or Poland, or I'm going to use a
China or
shorter term
somewhere.
strategy and I'm going to sell every month all the profit I make.
Well, I think that's exactly right. Like, to add to that, Steve, we've done pretty well over the last decade, our World 2 and World 3 strategy. They're longer term strategies. They allow for compounding, and we use the CAPE a lot.
Yep.
We're now moving more towards a World 1 strategy, because it's a lot more volatile. Shit's going crazy. We want to be in and out and take profits out. So it doesn't really matter as long as people listening to this have multiple strategies. That doesn't have to be 50 different strategies, but they have the ability to acknowledge an overpriced and more volatile market, and then the resources or tools to be able to say, okay, this, for us, World 2 and World 3 are probably not going to do as well as they have done over the last decade for the next decade, but World 1 will.
Yeah.
So we're going to be spending a lot more time there.
Yeah, it's the thing that happens a lot is you get this Warren Buffett, Charlie Munger aura, right? And what it is people say, I'm a value investor. I buy companies that are cheap based on value, or, they've got a economic, a competitive advantage, right? Now, there's absolutely nothing wrong with that. If you look at the data, you see that growth does really well, growth stocks, right? So you can buy crap like Netflix and Tesla and all that sort of stuff, and you will absolutely murder it. But it doesn't murder it forever. Now, value stocks don't murder it forever, right? So they fluctuate between growth and value. What I'm saying to people is what basically John Maynard Keynes, the famous economist, said. And he said, when the facts change, I change my mind. What do you do, sir? Right? And what Keynes is saying is what I'd say to people all the time. Look, you can be the smartest guy in the room, but if the CAPE is at 33, you are not going to make a lot of money by buying the American index for the next 10 years. I don't care if you're Warren Buffett or if you're some Joe Blogg in the street. But my point being, and it's just relating it to property by saying, it's the market out there that gives you the opportunity. And what we're saying is we're moving strategies because this is what we see as the market delivering us over the next 5 or 10 years. Right?
Don't get emotional about it. Just change your strategy and get on with it.
Yeah. I mean, if I sit here and go, no, mate, no, it's always going to be World 2 and World 3 and, all my money's going to be in those, that's pig ignorance in my mind, because that's simply saying, look, here's a really big brick wall. Well, I don't care. I'm really tough. I'm going to run through it. And it's like, okay, best of luck. But and that's not the way it works. The only thing, you guys know is you can buy and you can sell. The rest of it's up to the marketplace of, millions of investors out there. And if it's really expensive, well, so what if you've got $1 million? It doesn't mean you're going to make more money because the odds are not in your favour. It doesn't matter who you are.
Mm-hmm. So who do you reckon is going to get elected?
Jesus. God knows, but it's, oh boy. Who knows? You listen to some people and they say it's going to be, well, the polling sort of points to Trump. But that's why I've been writing a little bit about it, because it's like, this is a cliche. This is the most important election since I've been alive. But I can tell you,
since the last election.
Yeah, since the last one. But to be quite honest, this is seriously, man, oh man. When you look at the geopolitics of what's going on in the Middle East and Russia, there is military conflicts breaking out everywhere.
Yeah. Well, speaking of geopolitics, you've got all the shit happening in the Red Sea, which is going to cause inflation. So,
well, now ships are taking another 6 months to get here. The prices are doubled. You can't get insurance.
Didn't Shell stop sending anything through there as well?
Yep. So that,
So what are they doing? So they're not going through...
They don't go through the Red Sea.
Right, they're going around Africa.
So they have to go around Africa. So it's you have these canals, right, which are basically shortcuts, right? And what's happened is historically the Americans have have controlled the sea lanes militarily, right? And the deal was, look, we'll make sure that if you sell cars to Jacob, we'll allow them to get there and not be stolen along the way by pirates or, blown up or something, right? That's been the deal. Now, when you take the Americans out, it becomes a regional issue. So the Americans have been roaming the waterways of the world with all these huge boats, basically saying, well, if you stop that trade, we're going to blow you out of the water, and besides that, we'll come and, belt you seriously on land. Most have gone, oh, okay, we'll expand trade, right, because the Americans are protecting us. Now, that's been the whole world, and everybody's done really well out of it. But now things have changed. So what's happened is the Houthis now are saying, we won't bomb Chinese and Russian ships, but we're going to have a go at everybody else who's on the American side. So that's where you get the ships who say, and particularly the insurance companies who say, righto, if your ship goes down, we're not paying you out, right? Because you're in the middle of a war zone and that's not covered by insurance unless you want to pay us an extra $5 million per ship per day.
Yeah, right. So shipping costs are increasing, and it's more volatile through those canals and straits. So now they're going around Africa, which is taking 6 months longer to deliver some cargo. Yep. Which then increases the prices on that cargo, increases demand.
Well, you're getting the supply side problems like you had with COVID.
Yeah.
Right? You're getting the where's my Ford, F100? Oh, well, I'll pay instead of paying 80 grand for a new one, bugger it, I'll pay 75 for a second-hand one.
Yeah.
Right? Why? Because I can get it right now, and I want it right now. Like, as you know, with products, you can wait 3 or 4 months for a piece of furniture, right? Or
we waited 6 months for a table.
That's what I mean.
Shocking. Could have built one.
But that's what...
If you knew how.
If I knew how. Yeah. I was watching tennis instead.
From the private jet. But you see what I mean? That's where they're not, dare I say it, black swan events, but they're things that investors never had to worry about for 40 years. Doesn't matter, mate. It's okay. The Americans are running the waterways. It's all cool. I'll order my iPhone and bingo, it'll be here in 2 weeks. Right? Not anymore. Because there's all of these events where now, if you look at the conflicts, they're just breaking out everywhere. And I don't know if I put it in the week that was, I think it was too late, but Australia is now going to manufacture its own missiles.
Oh, I haven't seen that.
But you see what I mean? What I'm saying is we wouldn't have contemplated anything like that 20 years ago. Hey, let's make our own missiles. Don't be a dickhead. We'll just buy it from the Americans. Oh, yeah, good call. Right? Now we're making it ourselves. Right? And this is what's happening. Everything's breaking out where you look at that and then say, okay, everybody's talking about critical minerals. Right? BDY, the Chinese car manufacturer, is talking to a lithium mine in, don't hold me to it, but I think it's Brazil. Right? Why? Because they want to secure the supply of lithium to make the batteries. And I said this years ago, it's going to be in short supply. So what do? Just buy the whole goddamn mine, right? Just lock up all the supply for us. And that's what countries are going to be doing, right? America is going to say to Australia, listen, we want all those rare earths. We want all that graphite, right? We need all of that stuff that you guys have got. Don't sell it to anybody else, right? Or they'll say, right, we'll just buy, Linus Corp or, those sorts of things are going to go on because they're going to have to secure the resources in a hostile environment because now you can't get your rare earths from Africa because they get bombed on the way here or, they get ripped off by pirates or you say, well, yeah, we do that, but we have 20 American soldiers on every ship, right? I mean, it's serious. And that's why I say you can't look at that and say, as an investor, oh, yeah, it's just situation normal, everything will, continue on. It's like, no, you're going to get events where the stock price will be really volatile because it'll be, oh, they just blew up a ship that had, graphite on it or something. Oh, my God, that, now we're going to be short computer screens or blah, blah, blah.
Oh, we were projected to make 100 million, now we're making 80 million.
Exactly. And that changes the valuation of the company.
Mental. I know that one of the other things we discussed in the last couple of weeks that was is an
the week that was.
Yeah, look, I should have probably thought about that.
Yeah.
Anywho, obviously the market's kind of priced in another rate cut, although,
7 in the US, apparently.
Well, it just depends what article you read for what the story is.
That's true.
At this point, I'm not even going to try and guess. But, one of the bits and pieces that I read is, it's already sort of priced in.
Yep.
From what I understand, the Reserve Bank, they don't want to look at the monthly inflation readings. They like to look at the quarterly ones. So it'll be interesting to see, when that announcement comes out on the 31st, what sort of impact that might have.
I reckon everybody's way too bullish on the rate cuts. And again, it's the same stuff. The last 30 or 40 years, we've had rates fall from 18% to 0. Now everybody thinks they're just going to stay at 0. Sorry, that's not the way history works.
It only seems to be an issue, though, for property, right?
Well, because everybody's got a bloody negatively geared property.
Well, because of the valuation, right? Like that ABC article from the other day, which I thought was pretty funny, where they described it as a giant Ponzi and kind of underscored the fact that, people buying in today's environment, if they haven't held properties, to your point, since the 2000s, and they're looking to buy an investment property, they're borrowing money at 6 to 6.5%, and with an average return of about 3%.
And the property prices have gone from 400,000 to 1.4 million in 20 years. So in other words, you're borrowing when rates are relatively high, not absolutely, because they've been a lot higher in history, but you're buying high now and the price of the asset is really expensive. If you go and have a look at, now I'm talking about investing, right? If you go and look at the average yield on residential property in Sydney and Melbourne, it's absolutely goddamn miserable, right? It's 2 or 3% if you're lucky. Now, everyone comes back with, but it's going to go up 500,000 in 2 years. Okay, maybe, but what if it doesn't?
Yeah, well, there's a chart that you put out, I think, that was saying Sydney was 70% of households was 86 were negatively geared and 70% in Melbourne.
Jesus. I mean, honestly, let me give you the equivalent, right? You have the stock market, the ASX, the equivalent PE would be about 140, right? So tell me to go and borrow $1 million, right? Or these days, 1.5 million, as an investor, and go, I'm going to drop it on a property because it yields 2%, and I'm buying at the top of of a 20-year bull run.
Well, it's obvious people are relying on the capital gains, right? They're going, hopefully the next guy will come and lock in my profits for me, and then he can hold the bag until the next guy comes.
Well, that's the Ponzi element, right? You've got to have someone come along and go, I'm going to pay more than you paid.
It's super frustrating.
For exactly the same property. So in other words, you don't even come and go, but Steve's put another 3 bedrooms on the back that, generates $1,000 a month or something, right? It's exactly generally the same property, right? Because that's why I'm saying at least stocks are productive in the sense that Coca-Cola productively makes more and more Coke with the same assets, right? Which means it makes more money. Residential property is not that. Residential property is a consumption item. You've got to live in it, right? And you can't say, this year I had 3 bedrooms with 3 international students. Next year I'm going to have the same 3 bedrooms with 5 students, right? And then 6 students and then 7 students. That's productivity. You've got the same 3 students. Okay, you can raise the rent. But as we know, interest rates have gone from 0 to 4.5. Mortgages have gone from 2 to 6. So you've got to make a hell of a lot more money out of those students to make up
that aren't earning any more in wages.
Yeah, that's what I mean. You honestly, you just look at it and it's nuts. But because it's been nuts for so long, everyone goes, it'll just keep going on forever. And it gets back to what we were talking about with black swans.
Yeah, well,
I don't know what blows it up. Let me tell you, if you've got a $2 million mortgage on an investment property, okay.
Well, they're looking for the next good news, right? So now it's been saying this for a long time, but it's all international investors will come from China and they'll buy our properties, and then we'll get the Americans will come over and buy our properties.
But you listen to them. Sorry, Jacob. You listen to the mainstream media or a lot of the property people. They tell you that the mainstream media is going, property, everyone said it was going to fall last year. Don't listen to those guys, blah, blah, blah. And it's my point with stocks and property. So what? That was 12 months. Tell me what you bloody bought at and tell me what you're going to sell at.
Yeah.
Right? And so again, that's why I say you get this in stocks. Oh, the Cape ratio's bullshit, mate. You know, the stock market went up 25% last year. Okay, good for you. But, did you sell all your stocks in December the 31st and start again? No, mate, because it's all going to be great. Okay, good-o. Then it crashes and everybody says, oh, you couldn't have seen that coming. What? A valuation at 33?
Yeah.
And here's the last 5 times it's been at 33 and it's crashed. Oh, yeah, but, this time's different, blah, blah,
Couldn't
blah.
tell you the exact day, so you're wrong.
Well, yeah, and it is that. It's the old stuff. I think I was saying during the week, all of these guys are on there talking about Charlie Munger when Charlie Munger died. Oh, I'm reading Charlie's almanac and, I'm reading Warren Buffett again and blah, blah. None of them invest like Charlie Munger, right? None of them sit on their ass like Charlie did for 50 years, right? What they're doing is saying, oh, I found a really great quote with Charlie Munger and I'm going to use that. I mean, I don't use it personally, but doesn't it sound great? You should use it, right? And that to me is, quite frankly, a little bit devious in a way, because all it's doing is just saying, there's I'm talking to you, Jacob, there's a property person advertising going, oh, AI, I'm going to show you AI and how to make AI work for you with property or some crap. I mean, honestly,
Get on the bandwagon, mate.
Well, there's 2 bandwagons in one. It's genius.
But that's what I mean. That's the bullshit that you see in bull markets, right? If the Spice Girls came back out again, they'd have the bloody, let me show you how to make the Spice Girls make your money in property. It's like, oh, Jesus, come on. And you get that in stocks, right? You get the same thing in stocks. How
to make money, passive income every month.
Yeah. Oh, Jesus. I mean, honestly, you just look at that and it's just really, really deceptive. But because, and as I say, I'm not picking on property because the same thing happens in stocks, in bonds, in bloody art, in everything. You get the same shysters who have been through the latest bull market telling you that you should, buy a property, wait 6 months, it'll be up $100,000, and then you go and buy another one.
Well, it brings to the forefront NFT last year or the year before, whenever it was.
Yeah.
NFT artwork, people selling JPEGs, photos of bloody tables for $10 million.
Monkeys.
I actually photos of monkeys, for like $20 million. I watched a movie last night, I think it's called Thrift, with Kevin Hart in it, and he's basically stole some guy that made an NFT, and because they'd stole the guy that made it, the price of the NFT went up to $89 million or something, and they just flipped it on. But it's a classic example of like jump on the bandwagon when the bulls are running.
Yes.
And now this year, the same monkey NFTs from 2021 or whatever they were are now worth about 3 cents, but someone bought them for what, 30, 40 million, something stupid like that.
Yeah, and there's another one I saw, bunch of guys on Facebook going, I bought 50 of these things for $800,000, just sold one for $700. It must be going around again. I've just made a point not to even look at them.
But you see, what they do is they also buy and sell them to themselves.
To put the price up.
Yeah, to put the price up. So it's a scam.
Yeah.
It's a scam, right? There's one on my Facebook feed, right, who sells property programs and says, I kid you not, all of the rest of them are bullshit artists and scammers. Listen to me.
Yeah.
And I'm going to, and as I said to you, the creme de la creme is I'm going to do a seminar on AI and property. I mean, Jesus, seriously, is just.
We're in peak euphoria of the market cycle. God, we have been for a couple of years.
Absolutely.
And this is why we're saying, we're pretty passionate today, guys. I apologise. we're at peak euphoria. People are making dumb decisions. There's a lot of conflict and volatility. And it boils down to the fact that you need to have a strategy to match where we are in the market cycle. And I might leave it.
I'll shut up now.
And I've put a gag on Steve. It's not a pretty sight.
Give me a coffee and I'll calm down.
Are we going to wrap it up there, gents?
Yeah.
I think we'll just run a little bit over. As always, if you have any questions, head to the website, shoot us an email, or reach out wherever you can find us. We're all on social media. Until then, we'll see you next time.
Thank you. Appreciate it.
See you, folks.
The Total Money Management podcast is now releasing weekly. Follow us now on this app to stay up to date. And as always, remember, we don't provide financial advice.